We thought we would broadly start with some opening comments from each of the panelists. In doing that, I've asked the panelists to flag some of the things that are working really well in the UK, and also some of the areas where perhaps we can focus our efforts and address the challenges ahead. Just to recap, in terms of greening finance, as Tim explained, it's very much how do we green the whole financial system, so the systemic change that we need to drive capital towards a net zero future. And by doing that, integrating climate and environmental risks and opportunities across the whole system. In the strategy, we outlined 4 main ways that we're looking to do that in the UK. So firstly, establishing a shared understanding, which really speaks, I guess, to events like this today, to an understanding of the climate science that Emily presented, and to have a shared understanding of the financial risks and opportunities that presents. The second element we talked about was around clarifying roles and responsibilities. So, for example, the strategy outlines some of the actions we've taken in the pension space that no doubt Catherine may touch on, and some of the actions we've taken or we have committed to take to clarify the remits of the regulators, really reflecting a lot of the work that's already underway on climate risk. The third area was around enhancing transparency. So I'm sure that will be quite a theme of the panel. No doubt Tom particularly will pick up some of the work we're doing around TCFD. And also within the strategy, we outlined some possible areas of extending beyond climate to nature-related disclosure. And then the final element of our greening finance strategy was around standards and robust green financial frameworks. So lots to go at there. And I think we will start with Tom. We'll start with government, and then we'll move on to Chris to give a central banking perspective, then to Daniel to give a private sector perspective from his role at Hsbc, and then to Catherine. So firstly, a quick introduction to Tom, who it's been a pleasure working with as part of government. So Tom is Deputy Director at HMT. He oversees a lot of work around prudential banking, financial markets, so covers a wide range of issues. Also has a background in sort of international experience as well. And Tom is chairing our work around TCFD. So a real pleasure to have you here, Tom. Why don't I hand the floor to you for some opening remarks, and we take it from there.
Sure. Thank you. So Matt sort of introduced me already, but briefly, I'm the Deputy Director in the Treasury in charge of securities, markets and banking. And within that, one of my responsibilities is for TCFD and climate-related disclosure. We've also heard a number of points this morning on the government's work in this space, and in particular on the green finance strategy, so I won't go into that in much detail. But just to say there is a broader piece of strategic work across government, which runs from things like the Climate Change Act, which we heard about earlier, through to COP next year, and obviously the Green Finance Strategy that was published earlier this year. So a very broad agenda, and some really interesting work in there. On the financial services side, some really interesting specific things that the government is prioritising, and I think we can sort of say that we are world leading in some of these areas. You asked me to think about a sort of a priority or a challenge that we should focus on in particular, and you rightly guessed it's going to be around disclosure. For us, I think, certainly in the Treasury, we see this as a real opportunity and thing to prioritise. Getting disclosure right means getting the risks, costs and opportunities of climate change properly priced in. And that allows investors to make decisions correctly, that allows businesses and firms to properly factor in climate change when they are making their business decisions. So getting the financial system to properly recognise the prices, costs, risks, opportunities of climate change actually has the potential to have a huge impact in terms of changing the way that we allocate capital, changing the way that we sustainably finance future investments, and change the way the economy effectively works. It's something that we strongly believe in the Treasury, and the government has strongly committed to. The Financial Services Board's Task Force on Climate-Related Disclosure, TCFD, reported in 2017. Many of you will hopefully have heard of this, setting out a whole series of recommendations on how the private sector and governments can work with the private sector to improve this disclosure, and it covers a range of things from sort of governance, strategy, risk management, a whole series of targets. It's very ambitious, and it's still quite new. But the British government recognised the importance of it, and in the Green Finance Strategy this year set out our expectation that all listed companies and large asset owners in the UK, so a huge element of our economy, would disclose in line with TCFD by 2022. So we've set an ambition and an expectation, but I think this takes me on to my challenge, which is we now need to meet that. So the encouraging thing, I think, is we're seeing a real industry response. Without even us having to make regulation from a government perspective, we are seeing industry responding, we are seeing investors demanding this, we are seeing companies increasingly start to disclose in line with TCFD recommendations. And I think for us, one of the key things is not only that this is a tick box exercise, in fact, that it shouldn't be a tick box exercise, this should be an outcome-based exercise. And therefore, we're really interested to see the quality of this disclosure. What does it actually say? What does it mean? What can we learn from it? And there we are also seeing improvements. So some of the really complicated things in the TCFD recommendations around scenarios and how companies would act in certain scenarios, we're now starting to see companies properly assess that. So progress being made, but still plenty to do. And I think that's why, as Matt said, we've set up a task force within governments to oversee our implementation of this expectation. And that brings together regulators and different parts of government to work with the sector. In the first instance, we're going to be assessing progress, but we also have a mandate to consider whether we should actually make disclosure mandatory. And so we will be considering that as well. It is worth noting things like the FCA. I mean, I will let the regulators hopefully speak later on this, but the FCA, I think, this week came out with its statement that it's going to be making rules in this area, requiring disclosure for financial companies on a comply or explain basis. That's a very big step, and we're very encouraged to see that. So we will be monitoring this very closely and working out whether we need to take further action as government or whether actually the sector is delivering a lot of this itself. So I'll stop there. I think my main point, though, to take away from this is a big priority for government. There's a huge amount of work to be done here, and I think disclosure is a really interesting element of it.
Thank you, Tom, for those opening words. Obviously, quite a evolving area. So maybe then moving on to Chris Fate from the Bank of England. As many people know, the bank has played a very active role in shaping the agenda over the last 4 or 5 years in particular on a range of issues. So it's great to have Chris here, Prudential supervisor, a whole range of experience at the PRA and the Bank of England, including leading the bank's climate hub at the moment. So Chris, the floor is yours.
Great. Well, first of all, thank you very much for having me here today. As you may know, as has been trailed, since 2015, the bank's been investing significantly in understanding the financial risks that arise from climate change. And as you might expect, we have been focused on the risks from climate change rather than the opportunities given our remit. But we do recognise that these are both two sides of the same coin, because you can't effectively manage the risks from climate change unless you have a clear understanding of what the opportunities are to allow actors to move into. And for that reason, as well as a number of others, we really welcome the government's Green Finance Strategy, which we see as a big step in the right direction. But just to deepen my previous point, there is a really strong correlation between an understanding of the financial risk from climate change and the effectiveness of the green market. If the more information you have on climate risks and the more information you have on climate opportunities, the more effectively those risks and opportunities will be priced in, and the more effectively the market will be able to smooth the transition to a 2-degree world. But in order for this to happen, we think there's 3 big developments that we need to see. And the first one is, as Tom's touched on, climate disclosure has to become comprehensive. The second one is climate risk management has to be transformed. And the third is that sustainable investing has to go mainstream. And what I'll do just very quickly is touch on each of those 3, bringing out what we are doing as the bank domestically, but also internationally, largely as part of an organization called the NGFS, which is a group of 43 international central banks that are looking at similar things to us. So firstly, on disclosure. Now, as Tom said, the TCFD has now made an enormous change to the amount of disclosure that we're seeing in the market. And the signatories to this voluntary framework hold 120 trillion of dollars of assets. So this is a massive, massive move forward. And within the UK, we have told the firms that we supervise that we expect them to be disclosing on their exposures to financial risk from climate change as well. So this is really, really positive. But to move forward at the speed that we need to move forward, we think we do need to keep on pushing at this requirement, which is why the government's move to push this forward under Tom's group is really incredibly positive. And the UK and the EU have already made some statements about the need to go to mandatory at some point in the future at the right time. But it's also important that we, as the central bank, lead by example. It's not good enough for us to tell people that they need to disclose. We need to do it ourselves. So in line with that, we will be the first central bank in the world to be disclosing alongside the TCFD framework on all of our exposures from next year. The second bucket that I talked about was on risk identification and management. And at the core of this is the observation that effective markets, including green finance, are powered by a clear understanding of risk. And to provide this, the providers of capitals, which includes banks, insurers, and asset managers, i.e. the people that we supervise and the FCA supervise, need to improve their understanding and the management of financial risks, which sounds relatively straightforward, but actually this science is very, very much in its infancy. And what we have observed as a supervisor is that the physical risks that arise from climate change and the transition risks that arise from our movement to a lower carbon world will be material. And we have said to firms, it is not good enough to move at a slow pace to develop the techniques to understand these risks. We expect you to move at a very quick pace. So earlier this year, we put out a supervisory statement that said to firms, our expectation is that you will develop the risk frameworks, the governance frameworks, undertake scenario analysis, and disclose upon these risks in the future. And they're working very hard to do this at the moment. In addition to that, we recognize that there's a whole load of feedback loops within the system that we need to understand. So financial risks do not just arise in pockets, they will be magnified at the system level. And what we have said that we're going to do in 2021 is I think this is a world first, system-wide stress test to understand how these financial risks would arise across the system. But from a green finance perspective, I think we need to go further. And what we are doing internationally through the NGFS is developing a group of scenarios and frameworks that will be available to all members of the economy to actually monitor their financial risks. And the idea is that that will create consistency in how people are looking at these risks for the first time. And third, my third bucket's on returns. So today, as our understanding and data of risks improves, the financial markets are increasingly pricing in the opportunities and risks that provides. Now, we posit that those firms that move quickly will reduce the amount of stranded assets that they have, reducing their risks, which will have a beneficial impact on their share price, on the bonds that they issue, and their broader role in the market. Those that don't move quickly will be impacted to the downside. But we need transparency over what firms are doing. And one of the ways to do that is to build taxonomies of what assets are green and what assets are brown. There's some fantastic work going on internationally on this at the moment, but typically they're focusing on sort of the deepest green or the deepest brown. And what we think is required is a taxonomy that looks at the full spectrum of brown to green. So we can engage with firms as they move from brown to green across all of the economy, not just at the extremes, because actually when you look at the activity in the economy, the vast majority is in that area in the middle. So that's where the largest gains are to be made. I'm aware of time, so to conclude very quickly, these steps that you'll hear about today and that we've already heard about do mean that we are starting on the right trajectory to get to a transition to a 2-degree world. But we should not kid ourselves that this is a huge mountain to climb, and we need to move much, much quicker, and we need to turn all the good talk that's happening at the moment into actual action. So it's a step change that's required in the reporting, risk management, and return optimization that will help us to understand risks at the lowest level, it will help it at the market level, and that should help propel the transition to the 2-degree world. Thank you.
Great. Thank you, Chris. Really helpful summary there around the importance of disclosure, risk management, making sustainable investment mainstream. Be really helpful to get a private sector view on this from Daniel. So great to have Daniel Klier here. He's Group Head of Strategy at Hsbc, where he leads on the bank's sustainable finance work. I know, Daniel, you have a number of other hats as well, such as working with the Climate Financial Risk Forum and also being a member of the Green Finance Task Force that we responded to as part of the Green Finance Strategy. So a wealth of perspectives, and would love to hear your opening comments, Daniel.
Matt, thank you very much. And first of all, congratulations, I think, to the UK government and the Bank of England for the leadership in this space. As a German citizen, we normally picture ourselves as the leaders in recycling and climate change, but I think we now have to hand over that crown to the UK. So well done. Maybe just very briefly, many of you will know HSBC. We're obviously headquartered here with the Hong Kong-Shanghai Banking Corporation, so a very strong exposure and heritage in Asia, therefore I think a good view on emerging markets as well as developed markets. This year we've been named the world's best bank for sustainable finance. We're leading the green bond market, so we're number 1 globally in green bonds. So I think we have a good starting position, but I wanted to just take a few minutes to outline what I think is working well and where I think we have a lot more to do. So what's working well? I think the sustainable finance, green finance market is showing real momentum. Every year we see new record levels. The green bond market is only the most visible tip of that iceberg. It's growing 20-25% this year. Last year we ended at $180 billion. This year we'll expect it to go to $250 billion. So a very good growth rate and momentum, and what's encouraging, a lot more diverse real economy issuers are coming to the party. It used to be something driven by sovereigns and multilateral development banks. We now see a lot of companies actually participating in that market. And the other thing that I find really encouraging is that it moves below the public market. You now see a lot of green loans, green sustainable supply chain mandates, companies tapping this in the private market, and CFOs and treasury teams really care. The second is the seniority of this engagement has changed significantly over the last 2 years. This used to be a topic in the ethical corner, and I think now is part of really every boardroom, not just in Europe, but outside. I think the seniority and the platform is there. And the third thing that I find very encouraging, which I think really happened over the last 12 months, is we now have the right stakeholders at the party. We have the regulators, the finance ministers, the securities markets supervisors. So you have, I think, out of these three, a platform for change. But I think, as some people say, we've climbed the hill so far, but we have the mountain ahead. And why do I say we have the mountain ahead? I think we've made great progress, but if you take all the money that's flowing into green finance together at the moment, is a maximum of 1 trillion per year. And from all the numbers that we can see, we need to mobilize 6 to 8 trillion every year to achieve the Paris Agreement. Every year that we miss, that number will only increase. So we have a challenge that is 6 to 8 times what we do today, and that is a very significant challenge. And if you ask investors, why isn't this movement faster and why isn't this happening with everybody sitting on so much cash and making all these wonderful pledges, I think we hear 4 issues and 4 barriers. The first one is the lack of information and lack of disclosure. Financial markets work well once they have information. They can build models, algorithms, but you need information. At the moment, disclosure is very fragmented, and the type of disclosure that we're getting is very inconsistent. So markets can't deal with it. The second is the inconsistency of taxonomies and definitions. We all, I'm sure, sit in many, many different conferences, and we use all these buzzwords of ESG, SRI, SDGs, greenhouse gas emissions, but we don't have a common language. And every week we get new commitments, new pledges, and we have a very fragmented landscape that will not lead to the right amount of change. The third comment that we get back from investors in our annual survey is the lack of information. So while a lot of people talk about this, boardrooms, executive teams, but also the investors themselves don't have the right information to really judge what is green, what is brown, what is on the shade, what is moving fast enough. So education and training of executives and investment professionals is key. And the fourth barrier that we get every time, every year, and it's not moving and it's not going away, is the big mismatch of where money sits and where money is needed. Money today sits in pension funds trying to invest in liquid assets, US dollars with no political risk, and the money is needed in 20-year infrastructure projects, local currency, emerging markets with normally very significant political risk. And that bridging at the moment isn't happening at the speed that we needed to accelerate change. Let me just close with 5 thoughts for 2020, the super year on climate change, and hopefully the super year on the transition to a more sustainable finance, green finance market. One, I think, is raising the ambition. COP26 gives the platform both on opportunity and risk to move from a fragmented landscape of small commitments to a more holistic approach. The second is we need to shift focus to the hard-to-abate sectors and to emerging markets. I completely echo Chris's comments. We need to move away from the deep green and deep brown because the majority of the economy sits in the 95% in between. At the moment, the discussion isn't mature enough and the data isn't mature enough. The third topic is we need to find a way to finance negative emissions, and I think a carbon price is a critical element in this because with that you create a market that allows negative emissions, forestry, agriculture, all of these things to actually function because you create a market. The fourth is an alignment of stakeholders. The wide range of global different definitions and different stakeholders, I think, needs to be consolidated, and next year I think is a great platform to bring that together. And then my fifth point is echoing what my colleague said, disclosure, making this mandatory and aligning what good disclosure looks like, I think, is a critical element to accelerate the transition. Thank you, Matt.
Great. Thank you, Daniel. I guess a whole range of points there that would be really helpful to expand on in a little while. But maybe we just complete the panel with Catherine Howarth. Great for Catherine to join. Had the pleasure of working together, I guess, in various roles over the years. So Catherine's from ShareAction. ShareAction have been a very powerful voice to coordinate civil society on responsible investment, making investment a force for good. And Catherine's also actually a member of HMT's Asset Management Task Force as well. So can no doubt bring some new perspectives to the panel too.
Thank you so much, Matt. Good morning, everyone. As Matt says, ShareAction is a bit of a civil society watchdog, very focused on sustainable finance. We're a sort of advocate champion of driving sustainability thinking into the mainstream banking sector, asset management sector, pension fund industry, insurance sector. And one of the things we do as an organisation is rank the performance of the world's largest private financial institutions on how they're managing climate-related risks, sustainability factors more broadly. And the last few years have seen this absolutely wonderful flowering and explosion of kind of everybody beginning to get that this is really rather important. So it's been I've been Chief Executive of ShareAction for 11 years. The last few years has been quite a enjoyable roller coaster, and things are really improving. But I would say that when we do these rankings, what emerges is some very striking and encouraging leadership behaviour from a relatively small part of whether it's the insurance sector or the pension fund industry or the banking sector or the asset management sector. There's a long tail of laggards. And so a kind of key point I wanted to make is that actually public policy on financial services is what can drive laggards to leadership behaviour. The best in the sector, in the private sector, can demonstrate what's doable, but even they are helped by the kind of creation of a level playing field. But certainly there are lots of players in industry who I think are still kind of moving much too slowly, albeit that amazing things like the signals coming out of the Bank of England are certainly really influencing change. But we have seen, and I think the Paris Agreement is probably the thing that has really kind of opened everything up, and not least because embedded in the Paris Agreement text is wording that's really relevant to private financial flows and so on. So this kind of created the basis for the amazing movement that we're seeing. But only bold public policy around private finance can really deliver the change we need in the time we've got. Emily's slides, which are so striking, and I kind of one point I want to make is that sort of almost her first slide, loved it, that embedded in a way in modern capitalism is that it pays to externalize your environmental damage. It just has done that. It's been useful to kind of, you can make more profit if you externalize those effects. So that's the kind of core challenge at the heart of this, that whilst there are people recognizing the opportunity set, and whilst there are still lots of players in private industry and in private finance that are kind of locked in the status quo a bit. And so public policy can change that. I'm really glad that Daniel mentioned carbon pricing. That's the sort of big missing ingredient at the heart of all of this. But lots else can disclosure regulations. We definitely need mandatory disclosures. But we're going to have to go even bolder and beyond that, I would say. So just a couple of quick observations on why things are moving in such a positive direction around all of this at the moment. I would say that building on Paris, which was a huge signal, at EU level and here in the UK, we've seen this embrace of thinking, well, what do we really need to do about private finance? Recognizing, and this was a point that was made in the earlier presentation, that public finance certainly isn't adequate to the task. So we've really got to get going with mobilizing private finance. And, pension assets are a really important part of that. I might come on to pensions in a minute. So the EU has got this new Sustainable Finance Action Plan and a whole bunch of really quite interesting bits of legislation emerging from Brussels, whether it's the taxonomy on green finance or the benchmarks legislation, disclosure regulations, really interesting legislation out of Brussels. And I hope that the new Commission will maintain the pace around that. But I'm very proud of what we've been doing here in the UK as well. And actually, it's been kind of interesting to see, obviously, EU and UK, it's a very interesting day for that. There's another summit going on other than this one. But despite all that kind of challenge and tension, this is an agenda where everyone seems to be working on a positive note. So, and I also would note that both left and right seem to agree that private finance engaging with this agenda is really important, but also EU, UK. So that's been really positive, and we need to keep it that way because, we observe in the US, where this is so politically polarized, how far behind they are relative to the really positive dynamic where this feels like something that lots of players can get behind. So just a couple of quick reflections on what's happened in pensions. Private pensions are an enormous pool of global capital that needs to be deployed in a different way to meet the capital requirements, the capital needs that Daniel outlined, to transition and transform every sector of the economy. And the purpose of private pension funds is to help people invest for the future so that they can have a secure old age. If we do not manage climate risk well, if we do not keep emissions coming down, there's no way anyone's going to have a secure and delightful retirement 30 years hence. So this has to sort of come right to the heart of the purpose of pension provision. And it really makes sense for fiduciary investors running pension funds to be very ambitious on decarbonising portfolios, pushing companies through stewardship to really think not just at the extreme green end or the extreme brown end, but right across every sector, that we need very ambitious transition pathways. And pension funds as owners of assets are in a really strong position to do that. So it's been really good that the UK has new pensions regulations. They came into force on the 1st of October, so pretty much a couple of weeks ago. And they require pension funds for the first time in the UK to have clear policies that show how they're going to manage and consider climate-related and broader sustainability and ESG financial risk. Pension funds will have to report against that every year. It's the first bit of pensions legislation in the UK where the words climate change are in the Act. That's really positive. But I'm going to say that I would say it's still all a little bit too tame. It's not in itself as a piece of legislation or those regulations yet going to move pension funds from where they are today, which is basically 4-degree aligned portfolios, to where they need to be, which is 1.5 to 2-degree aligned portfolios. Mark Carney, brilliant evidence yesterday to the Treasury Select Committee. We're in a 4-degree world kind of capital market system at the moment, and that's true for pension funds, not just here in the UK, absolutely all over the world. In fact, it was the Japanese government pension fund, the largest pension fund in the world, that said, we look at our portfolio and it's aligned for a 3.7 degrees world. Not good for Japanese retirees or workers, just the same as those all over the world. So we need to be more bold, I think. And interestingly, in the UK, we have a new pensions bill in the Queen's speech, a really interesting opportunity. It doesn't have lots of stuff on climate change, but again, there's this very interesting cross-party dynamic where the other opposition parties and the pensions minister in this government have been making wonderfully interesting and positive statements about the need to align our pension system with the world's climate goals as expressed in the Paris Agreement. So lots done, lots more to do. I just really want to emphasize to this audience how utterly critical public policy is to enabling private enterprise and private finance to do what it needs to do to help us on this journey. We've got Paris. That was a wonderful foundation. The UK will be hosting, at the end of next year, the Glasgow Summit. So we're in a brilliant position in the UK to do something very special and to put private finance at the heart of whatever agreement internationally emerges out of the Glasgow Summit. And I think we've got all the building blocks, but we have to be very bold.
Great. Thank you, Catherine. So a range of perspectives, I guess, across a range of issues. Hopefully some good news, some things that we can really appreciate that are working well, as well as some challenges, obviously, responding to the situation that Emily and Tim have outlined. I guess a common theme, I guess, that's come through nearly all these opening comments is one of disclosure, the importance of that. So it would be quite interesting, maybe starting with Daniel, to get a sort of private sector view of what would help you to put quality disclosures into the market, and what do you need from the firms that you're lending to do that? And is there a role for central banks or for government to do more? What are the barriers there? And perhaps we'll take that and get different views around that issue.
Yeah, thank you. As you said, I think there's a big consensus that what we currently have in the public domain is not fit for purpose. That is largely driven by very inconsistent disclosure. So if you look at the different levels of what people, well, first of all, a very small proportion of the global economy has actually signed up to TCFD. And then the people that have signed up to TCFD are reporting very different types of information. So if you are a global investor or a financial institution that wants to get an understanding of its balance sheet, it is very, very hard. We can understand what is very, very brown, and we can understand what is very, very green. So the coal wind discussion is a very easy one. But then we go down to, I think, the number that I always find striking is the 70% of global greenhouse gas emissions come from the 100 largest companies in the world. None of them are pure. They're all on that spectrum between green and brown. And at the moment, we have no way of really assessing where companies stand. So we've disclosed in our last TCFD report that 21% of our balance sheet is in sectors that we call high transition risk sectors. But we're not saying that in 5 years from now, that number has to be 0. We're saying that the companies in that sector have to move. And to assess whether the companies in these sectors are actually moving towards a net zero world, you need good information. Otherwise, you get to a very brown-green debate, which will not help anyone. So if you look at the oil and gas industry, the automotive industry, the construction industry, the chemical industry, all of these industries have the investment power to be the solution, but if they don't invest, they're the problem. And I think that level of information currently isn't there. So we need, I think, an integration of the type of disclosure that financial markets will find useful into normal accounting standards. Mm-hmm. And that still seems quite a far way away from now. Mm.
Thank you, Daniel. Chris, do you have views from a Bank of England perspective?
Yeah, so I agree with, I think, everything you just said. So we have a very good idea of what kind of disclosures we would like to see, what kind of information we think would help the market. And one of the arguments is that you should just make it mandatory today and get firms to publish that information. But the unfortunate truth is that firms don't have that information at the moment because typically it's not information that they've collected, so they've not had those discussions with the people that, say, the banks have been lending to. And also, it's not just about core kind of lending information. There's an element of judgment in it, to go to Daniel's point. What is green and brown? Even if you have a taxonomy, some firms do deep green and deep brown activities. Oil firms, energy firms often investing in oil, and also some of the largest investors in green finance, in green innovation. So this is a really tricky area for us to get information on. Now, that's not to say that that should be a barrier to disclosing. We should push disclosure as quickly as possible, and firms should be seeking to have those discussions and collecting that data as soon as possible. But you need to recognise that you can't just turn a switch and disclosure would be available tomorrow. And on that, I think there's a broader point that I'll just bring up from what everyone said. It's fantastic that we can drive forward the agenda in the UK, and we've heard about a huge number of good things that we're doing here, including moving to net zero by 2050. But the UK is only a small part of the world, and a lot of the largest companies, well, most of the largest companies, and a lot of the pollution comes from outside of the UK. But luckily, the UK does have an incredibly powerful voice, both from a government perspective, the influence of its firms, the influence of the central bank. And I think, as well as the domestic changes that we're putting through, we should be seeking to really drive forward the international agenda on all of these aspects, including disclosure, which to date we have been doing.
Really helpful. Tom, obviously there's things that we've outlined in the strategy of how we're looking to support disclosure through guidance, through looking at data, other things like that. Do you want to add anything from a sort of government perspective as the task force continues its work?
I mean, there's a risk I'm going to agree with my two previous speakers. I think I very much endorse what they've said. It's very nascent at the moment, and I think that is the challenge, that we have just had this sort of big debate and discussion and development of disclosure requirements, and we're still sort of in the process of seeing them be put into place. And I think that was the reason that the government took the decision not to mandate at this point disclosure requirements, because it wasn't entirely clear what we would be mandating or what we would get. But I think now we are starting to see this market response, and we are starting to see lots of things being developed by firms which are starting to fill this gap. And alongside that, the role of government at this stage, I think, is to set the expectation, to set guidance, to provide support, but also to signal that we expect this to happen. And if we don't see this working sufficiently, then we will need to work out what we need to do next.
Yeah, that's really helpful. And obviously, it was really interesting, Daniel, earlier when you were talking about how climate and environmental issues have shifted up to a boardroom level. So in some ways, I think disclosure and TCFD has also created the behavior change as well as putting information in the market. So, I mean, Catherine, are you seeing sort of pension funds now moving the disclosures, as disclosures are happening in the pension fund area? Is that actually leading to moving capital to address some of the challenges that we're seeing?
One, I think, brilliant feature of the TCFD framework is that it's a common framework for both kind of companies out there in the real economy delivering goods and services and for financial services. It covers pension funds, it covers as asset owners, it covers asset managers, and there's a very good piece of work going on at the Department of Work and Pensions to look at how TCFD applies to pension funds, and that will lead to some guidance, and that's really good. Just to echo a bit what Daniel was saying, that there is obviously this uptake of firms who are saying, who've made this public commitment to TCFD and reporting, and some of them have issued their first reports. I think I saw a number the other day, it's around 180 firms globally, which does put a bit in perspective. That is such a small number of firms that are highly exposed to climate-related risks. So I'm very sympathetic to the view that I certainly agree that firms are not ready to disclose yet, because it requires putting in place serious kind of new internal systems, looking at a whole lot of things that haven't been looked at before. But the sooner we have the signals that this is going to be mandatory, if not next year or immediately, in sort of 2 years' time, the sooner boards of directors of firms, whether in the financial markets or in the real economy sectors, get their heads around the prep and the process, and allocate resources to people that have to design these systems. And then it also drives, of course, conversation, because we don't want every firm disclosing in a different manner or kind of selecting its own. I mean, that's just disastrous, because the point of this, the reason we want this disclosure is that it can help improve the quality of decision-making and risk management in capital markets. Insurers, investors, banks all need to be able to assess, because it's a complicated world, as everyone has said. We've got big companies with a very mixed portfolio of green, brown, and something that's in the middle. And kind of working out what that means from the perspective of someone, an investor that needs to manage the risks around that is a really complicated process, and every company's doing it differently. We are not going to get the kind of step change in risk management and improved decision making that we badly need. So I think we should. I think disclosure is just getting the data out there that helps people manage risk and think about these issues and integrate it is sort of utterly essential if we think that the private sector has an important role to play in solving climate, which I do believe. But then to kind of re-emphasize my earlier point, we need public sector, public policies that create the frameworks in which all these actors in the private sector and in finance can do what they need to do.
Yeah, for sure. And I'm sure we'll continue the theme of the importance of public policy in the next session and throughout today as well. Daniel, did you want to add to that?
Really quick addition. So we signed up to TCFD 2 years ago, and it was transformational, because it meant that it's no longer something that we put into a lovely CSR report with a lot of smiling children on it. It's in your annual report. If it's in your annual report, your board has to sign off, auditors go through it. It's transformational because it means you need to put the whole machine to work. So it sounds like a very small step to sign up to TCFD, but the amount of change it delivers in an institution is transformational.
Yeah, and I think we've seen that as well, which is why we were so keen to lay out expectations in the strategy, as Tom has discussed, and to pull together the various folk we need around the table to move forward and have a consistent approach, and to really see that behaviour change beginning to make climate environmental factors a strategic issue and then begin to shift the trillions of dollars of capital that we need. I'm conscious we've got about 15 minutes or so left. Would love to get some questions from the floor. Obviously, a range of topics, the sort of risk management and scenarios are the things that we could also dive into here in terms of how to really green the whole system. But just wanted to open out to see if we had any questions at this stage. Yeah, quite a few as expected. So maybe we'll do it in batches of 3 and then bring it back to the panel. So we've got a gentleman there, and then a gentleman in the Rob in your blue white check shirt, and maybe the lady behind you initially as a batch of 3.
Thank you. In relation to TCFD and its impact on financial services, listed entities, capital markets, etc., I welcome it. I think it's fantastic. Can you see this leaking into private equity, which is where we're actually funding growth within the economy, and going on from that, looking at, for example, the UK, a significant proportion of GDP is actually spent by the public sector. So in addition to policy setting, do you not think the public sector should also adopt a similar scenario-based, forward-looking set of options for how it spends our money?
Great. So interesting question there, and possibly public sector, TCFD. How should we look at that? Rob?
Thanks, Matt. Rob Gillies from the Natural Environment Research Council. We're just at the moment doing some more work on some more funding on climate risk sort of analytics work. And we saw, I think from Emily this morning, one of the things about the UK that we're also leading in is climate science. But I'd make the observation that traditionally climate science has been primarily about identifying, diagnosing, quantifying the scale of the problem. So I just wondered if the panel had any thoughts on sort of key objectives for funding into the science base by which we can deliver science that is in a format that's much more sort of decision relevant, decision ready for financial services community to make better investment decisions. So critically, it's those objectives about bringing that science into a sort of decision ready format. If you have any observations on that, thanks.
Great, thank you, Rob. So it's just translation of science into financially relevant information. I know we have a panel that's going to dive into that a little bit later, and then maybe one more question.
Hi, Katie Spooner from the Environment Agency. When we talk about physical risks in terms of disclosure, we quite often talk about stranded assets. But I just wondered if you thought that there was a strong enough consideration of the physical risks related to some of the challenges we see in adapting to climate change, particularly issues around flood, drought, issues like that. A kind of second and third part to the question. So if so, what do you think are the barriers to disclosing against kind of adaptive challenges? And are there any lessons that we can learn in terms of pricing this risk from other resilience measures such as earthquakes?
Great, really important question on around resilience and adaptation too, which is obviously a key part of the strategy. Any volunteers, maybe picking up the sort of the climate science question initially? Catherine? Yeah.
I would love to do that. I really think that a little project that we plan to undertake at ShareAction in the next couple of years is to really challenge and ask the boards of large financial institutions if they think they have enough deep scientific capability to understand the physical realities of a lot of this, and to make sure that advice and understanding, that scientific perspective, is feeding into decision-making on the boards of financial institutions. I think it's all actually part of the diversity agenda in finance, which the Treasury's been doing brilliant work on women in finance. That's really important. Asset management sector has a particularly significant problem on gender diversity, but is grappling with it. But it's not just about gender; it's about scientific perspective and cognitive perspectives. And actually, it's incredibly important that we bring that knowledge and understanding, and that there's a better conversation between the scientific community and finance, not just relating to climate. Biodiversity is, perhaps more complicated actually as a challenge, and one where Again, the Treasury is doing a brilliant piece of work with descriptor on biodiversity and its implications for the economy. And I think there's really good opportunities. So one thing we'll be doing at ShareAction is asking questions at the annual general meetings of all the UK's listed financial services firms next year, I hope, on challenging those boards to think about, do they have enough scientific expertise feeding into board decisions and making boards really consider, and it does relate to your adaptation question as well. I think it's all kind of wrapped in together a bit. Great question.
Great. Daniel?
Happy to just add to the 3 points. On the first one, I think the best way to get smaller companies that are not listed is through supply chains. So a lot of the big companies will have to understand their full carbon footprint, not just the one that is in their direct control. So I think that is the measure to get into smaller non-listed companies and affect change. And we see that already with some of the big developed markets companies pushing that agenda. Climate science, I completely agree, but I think TCFD and for us, the work that the Bank of England is doing will drive this. So we are working, apologies for the UK institutions, we're working with the MIT on how do you translate climate scenarios into what's most important, sector policy responses. Because the biggest risk for a financial institution is actually that governments are banning certain technologies at a speed that's faster than the normal lifetime of it. Mm-hmm. So if you ban the internal combustion engine, if you ban coal from the system, then you get to real financial losses because an asset becomes worthless from one day to the other. And that's the intellectually hard work. I completely agree with physical risk, but I almost think physical risk is the easier one. So we can isolate actually the physical risk elements quite easily. There's a lot of data, satellite data. We know which areas of our retail mortgage portfolio are in flood areas. There's a lot of work in there, but it's almost the easier bit. The transition one is the hard one because you have to assume technology, pace of technology, technological advancements, policy interventions, and that makes it so complicated.
Great. Thank you, Daniel. Maybe we go to Chris. And then we'll give a bit of an HMG view on some of the other aspects of the question.
So similarly, just to whip through those 3 questions on the TCFD. So the TCFD is a framework that was designed for the private sector, but it is really adaptable. And we are, as I said, we are looking to disclose all of the Bank of England's activities alongside the TCFD framework from next year. But it's not easy, and it does take a huge amount of work to map what we do as a non-private sector organisation to the framework. But we're going to give it a good go. So watch out for that next April. And I think the point on science and research is really, really core to everything that we're talking about here, because the types of risks that we talk about are actually relatively unique in a number of ways. And because of that, institutions, including us, are having to dig deep into the scientific community to understand actually how we should think about these risks. And the scientific community is fantastic, I should say, in this space. It's eclectic, it's full of characters, and we are learning how to do this, but it is a slower process than you might think. And that, to echo Daniel's point on physical risks, I think there is more research there, particularly in insurance companies that have been modelling this for some years, and there's more data. It gets really hard when you start looking at transition risks because you're making very, very big judgments about human behaviour, government behaviour, technological innovation. So that is something that we are watching incredibly closely, and we, together with firms, will have to work closely to ensure that we're not duplicating effort and being as efficient as possible.
Great, thank you. And maybe just to give a little bit of a HMG view on some of those questions, maybe I'll say a few words as Bays and then Tom, obviously, to dive in. I think on the sort of public sector exposure, public sector TCFD, we did in the strategy outline some areas where government can lead by example. So, for example, commitments from UK Export Finance and CDC to be considering TCFD disclosures, I think, by 2020, 2021. So I think there is a movement in that direction. It was really interesting, actually, yesterday, not that I do this every evening, but I was listening to some events at the IMF, and the incoming managing director of the IMF, Kristalina Georgieva, was saying how the IMF now are looking to integrate climate risk into their country surveillance, which is also quite an interesting development for people to be aware of. And then in terms of sort of the resilience adaptation side, we're really keen to ensure that the strategy, the green finance strategy, is not just about net zero, but really a net zero resilient future. So a whole range of things happening around resilience. You might hear a little bit more on that on the next panel, but it's a theme that the UK has been leading on at the recent UN Climate Action Summit, including backing a coalition of climate resilient investment. So really important we work on the adaptation side for sure, as Emily has already outlined in terms of the science, as well as the importance of getting to net zero. Tom, I don't know if you want to add anything.
Sure. So I think you've covered it very well. So I think in terms of sort of government spending and sort of the however many £100 billion that the government allocates every year, I think we're not there yet. As Chris said, the TCFD recommendations weren't really designed for that. But I think it's really interesting to watch bits of government starting to respond. So you've heard the Bank of England talking about how they are doing this, and as Matt said, other smaller parts of the government are doing it. And I think this is something we will want to watch and learn from, in the same way that we're learning from the private sector as they're implementing these recommendations. I mean, you also mentioned other parts of the financial services sector, things like private equity. You're right, I think there is a really interesting thing in there. We said we wanted listed companies and large asset owners to participate in this. Our locus for requiring that gets more tricky as you get further away from the disclosure requirements of, say, stock exchanges. But we need to think about how we can help support, but potentially also encourage companies to do that.
Great, thanks. So we've got about 5 or 6 more minutes left. Maybe we've got time for one more quick round of questions, and then the panelists maybe also sort of closing remarks in response to those. So, lady with the blonde hair in the middle there, gentleman down here. Am I missing anybody else? And yeah, lady towards the back there. Thank you.
Hi, I'm Sarah Minch in WWF. I'm very pleased that you mentioned the fully fledged taxonomy, or the need to create a sort of a framework for those grey areas between deep green and deep brown, which is probably the most of the market, and which is arguably where we need most of the transition to happen and to finance that transition. Now, WWF was really pushing this point with the European Commission work, but as we know, it's ended up as just deep green. So I have 3 questions. Who do you think...
One question, how's that?
So who do you think would be leading this work on creating this framework or a taxonomy? How long will it take?
Great.
And could we include
so we have a question on
other
taxonomy.
major risks
Brilliant.
beyond carbon?
Thank you very much. Really interesting question on taxonomy, including timing and other such things. Next question down here.
Thank you very much. My name is Luis Gonzalez. I'm from Minister of Finance of Chile. And my question is about macroeconomics, especially for the Treasury and the Bank of England. And mainly, I want to know how you are dealing the possible impacts, for instance, in the fiscal deficit, and the spending, how you're planning. There's a lot of range of numbers of how to finance the net zero target. And also related with that, in the short term, how is the perspective of the Bank of England regarding the impacts in inflation because of physical impacts of climate change, like in agriculture and everything? If you see that there is a real risk in that area that will affect to the monetary policy. Thank you.
Great. So really interesting question, macro economics and around the fiscal side. And then one question at the back. So the lady in the middle here.
Hi, is that, yeah. My name's Yasmin Raza. I'm managing an inquiry for the Treasury Select Committee on green finance. We've received some quite interesting evidence to our inquiry about the fact that even though the UK is only responsible for 1% of global greenhouse gas emissions, the City of London is responsible for 15%. So I was wondering what the panelists' views are on whether that is compatible with our new net zero target and what could be done about that.
Great. Another really interesting question. So maybe we work from Daniel back in terms of any responses to those. Don't feel you have to take them all on. And any quick closing thought.
Yeah, I'll be very quick. I think on the point of the 15% greenhouse gas emission in the City of London, you can see this as a problem or as a huge opportunity. I would see it as a great opportunity because the Bank of England is absolute leading in the space globally. And if you have the most ambitious and probably toughest supervisor in this space overseeing 15% of greenhouse gas emissions rather than 1%, I would be actually in a comfortable place. Mm-hmm. I'm slightly concerned about a 400-page taxonomy as a solution to the whole problem. So I believe that we actually need to get to a much better view on the aggregate company and the carbon intensity of a company portfolio and how that aligns to Paris, net zero, whatever you set as the target, rather than understanding every single investment. And so I think both levels are important, but we run the risk of getting confidence that they understand 2% of their incremental spend, and we don't understand where actually the stock of capital really sits. And so I'm a bigger advocate of actually understanding the total carbon footprint of a company and how that moves towards a net zero scenario rather than every single investment dollar. Right. Overall, I think 2020 is the super year. We have 56 weeks left to go to COP. There's not a lot of time. I think we better get going.
Great. Yep. Thank you, Daniel.
You're welcome.
On that inspiring note, Catherine?
Well, I think I would commend the Commission on the ambition of what it took on when it thought about green taxonomy. I mean, it's something that's needed. It's a piece of infrastructure, if you like, to help with decision making. I share, in a way, the disappointment that it's sort of focused. It's ended up being just a sort of quite a pure green taxonomy. But I also do take on board Daniel's points. I think this. My understanding is that there's efforts underway here in the UK, which the Investment Association is involved in, to think about what more needs to be done in the area of, providing a taxonomy to understand the exposures of different sectors. But, as we've already, a number of us have articulated, it's quite complex. Most firms are a bit of a mixture of everything. But what's needed to drive the change is investors thinking of themselves as stewards of companies, encouraging boards to sort of dial up the number of green activities in their overall corporate portfolio of business activities, to dial down the more environmentally damaging activities, and to innovate and to spend R&D on what's the opportunity set here. So it's so complicated because the economy is moving all the time, and innovations are emerging which won't fit in last year's taxonomy. So it's not a simple task, but I think it's really good that the EU had the kind of audacity to have a go at it, but it's clearly work in progress. And I think it's a good example of something where actually we need a lot of international cooperation and we need the best brains. The TCFD was an effort to bring, kind of guided by central banks and by Mark Carney and Mark Bloomberg, to bring the best brains in the private sector to head together to find a solution. And we probably need something perhaps comparable for taxonomy. I would also actually echo this point that the City of London is definitely financing a vast amount of really problematic activity, but we're on a real, I think our institutions in the financial services industry here are really transitioning. We've talked about that for the whole panel long, but it's work in progress, it's happening. And it is a big opportunity for London, which I think we just need to be very bold and grasp it. And that probably does mean saying no to certain things, but then embracing the opportunity set of this transition and what finance can bring to that. It's a big commercial opportunity for our banks, our insurers, and our asset managers, and they should grasp it.
Great. Thank you, Catherine. Chris?
Thanks. I don't think I can really add much to the taxonomy responses that have already been given. On the macroeconomic impacts of climate change, so to build on my previous point, at the moment we don't have comprehensive models to understand what these impacts look like, and there's a number of different pathways that could happen that would lead to dramatically different outcomes in the economy. So with that in mind, the stress test, the scenario analysis that we're doing in 2021 is going to be a really, really key part of the process to build up our both domestic and international understanding. And what you might expect to see in that exercise is asking industry to model different scenarios, varying from the most extreme scenarios where there is no policy action beyond that's been announced today, to more amiable scenarios where you have a smooth transition, and thinking about exactly how those play out in terms of the combination of transition risks, physical risks, what it means for the system, and that will allow us to think more about what it means for the economy as a whole. So 2021 will be a really key year for that. And on the City of London point, I mean, I think it's a really fantastic figure that I hear a lot. I mean, from the Bank of England's perspective, the thing that we're really focused on is making sure that all firms understand the risks that they're taking on, and those risks are building in the future impact of climate change. And we want firms to recognize that maybe if they've got a carbon-intensive set of customers, the credit quality of those customers is likely to go down, and we want them to disclose on that, and then the market can do what it needs to do with that information. As you talk to investors, as you talk to the market, you definitely get the impression that there's an increased drive to understand these risks, and the market will move against those firms that have elevated levels of climate risk. So we're seeing that process happen at the moment, and as we get more data, more understanding of the risks, my expectation is that that will accelerate.
Great. Tom?
Sure. So again, agree with an awful lot of what my colleagues on the panel have said. On the EU side, I mean, I think the points that Catherine made were very right. The UK has been very supportive of the EU's work under the Sustainable Finance Action Plan, including on the taxonomy work, but also some of the disclosure things they put in place, some of the things around benchmarks, some really interesting, quite innovative things that are being established. And the UK has committed to at least matching the objectives of many of those things in the Sustainable Action Plan. So for us, I think, things like the taxonomy, it's a good place to start. It clearly needs work. It's a very difficult thing to do. I mean, I think we sort of appreciate the work that's got into it, but clearly it doesn't take us there yet. In terms of the sort of macroeconomic questions, I mean, I think Chris said it very well. The points earlier on highlighted the size of the financing gap, and I don't think anyone can realistically think that government could fill it alone. This has to be something we do with the private sector. This has to be something that we do as a whole society. The government has, and has had for a long time in the UK, cut various different environmental taxes in place and various different things that we finance. But I think it goes back to this previous point. How do we make society as a whole get behind this challenge and adapt? Because otherwise, I just don't think we can meet that financing gap.
Great. I'm conscious that while we don't have that much time to COP26, we also don't have that much time left on the panel as well, so we've gone a little bit over. I know that there's some sessions this afternoon that I think will give the opportunity to go a little bit deeper to some of the questions that have been asked, and maybe if we had a little bit more time, we could answer a little bit more fully. But let me just finish by really thanking the panelists for their time today. I think this has been a really interesting panel, and just indicates the amount of work that we still need to do, but perhaps also a chance to appreciate what is happening and what has been done. So thank you very much.
Thank you.